If you own a rental property, this one's for you, because nearly 9 in 10 landlords, the ATO reviews have errors in their rental schedule, ATO 2023. Don't bet against the house. And the villain here isn't the tax office. It's the fine print on your loan, your renovation invoices, and your holiday home calendar. Get it wrong and your refund's at risk, with interest and penalties on top. This cuts both ways. Some landlords overclaim and owe it all back with the ATO's general interest charge. Others severely underclaim and quietly hand over thousands they were entitled to keep. There are 3 moves to fix it. Audit your interest apportionment, reclassify your repairs versus capital works, and check whether your place was genuinely available for rent. Here's the number that should make every landlord sit up. In recent ATO audit work on rental properties, nearly 90% of returns checked contained incorrect claims. ATO 2023. 90%. But here's the part nobody tells you. Most of those errors aren't sneaky cheating. They're honest mistakes about interest, repairs, and private use that the rules quietly turned into a problem. 3 moves. Audit your interest, reclassify repairs versus capital works, and check genuinely available for rent. Each takes under 20 minutes, and all the tools are free. Move 1. Problem 1. Interest. The ATO only lets you deduct interest that relates to the income-producing use of borrowed funds, ATO 2024. So if you refinance your investment loan and use some of that money for something private, a car, a holiday, a renovation on your own home, you must apportion the interest. Only the investment portion is deductible, and only the interest counts, never the principal. Here's how a small mistake snowballs. Say you've got a $600,000 interest-only investment loan at 6%. That's $36,000 of deductible interest a year. ATO 2024. You top it up by $100,000 for a private reno, but keep claiming on the full $700,000. Now you're claiming $42,000. That's $6,000 overclaimed every single year. ATO 2024. Problem 2. Repairs versus capital. The ATO splits them sharply, ATO 2024. A genuine repair, fixing a leaking roof, replacing part of a fence, is immediately deductible, but replacing a whole asset or improving the place beyond its original condition is capital. Structural capital works fall under Division 43, deductible at just 2.5% a year over 40 years. Get this label wrong and the damage runs both ways. Picture a $25,000 kitchen replacement claimed in full as a repair. Correct treatment is capital works, $625 in year 1, ATO 2024. So you've overclaimed $24,375. At a 37% tax rate, that's around $9,000 clawed back, plus the general interest charge. Or you go the other way, claim nothing, and lose thousands in deductions over the years. The myth that traps people. If the loan is in the investment property's name, the interest is deductible. It feels logical. The bank even calls it the investment loan, but the ATO rule is that deductibility follows what the money is used for, not what the loan is called, ATO 2024. Redraw for a private reno, and that interest is gone. Stack both problems together on one investor and it's brutal. Overclaims on interest and misclassified repairs can mean around $18,000 of tax clawed back over 5 years, plus interest, author's estimate, ATO 2024. And underclaiming missed capital works adds nearly $9,000 more in tax you simply didn't need to pay. A $27,000 swing, before penalties. Meet Sarah. She's 38, a marketing manager in Sydney earning $130,000, right in the 37% tax bracket. She owns one apartment in Brisbane, bought for $650,000 back in 2020. On a $550,000 interest-only loan, she's got 29 years to retirement. She thought her return was fine. Here's what Sarah found. Discovery 1. $6,000 a year. In 2022, Sarah refinanced and topped up $100,000 to renovate her own home, but she kept calling the whole thing the investment loan and claimed the full $39,000 interest. Only 84.6% was deductible, ATO 2024. That's $6,000 overclaimed a year, about $2,220 in tax annually. Discovery 2. $19,500. In 2023, Sarah spent $15,000 replacing a whole bathroom after a leak, plus $5,000 on new flooring throughout. And her accountant claimed the full $20,000 as a repair, ATO 2024. But replacing the whole asset is capital works at 2.5%, $500 a year. The overclaim exposed her to about $7,200 in tax. Discovery 3, and this one stings the most. Sarah's apartment was newly built in 2020 with around $240,000 of eligible construction costs. She assumed the builder had already claimed it all. Wrong. Division 43 capital works belong to the property, not the builder, ATO 2024. At 2.5%, that's $6,000 a year, and she'd missed $24,000 in deductions across 4 years. Add it all up. Across just 5 years, Sarah's overclaims plus her missed deductions add up to roughly a $27,000 swing against her position. And that's before the ATO's general interest charge and any penalties authors estimate, ATO 2024. Stretch the interest error and missed capital works across her 29 remaining years, and the lost tax runs into the tens of thousands. So, could this be you? 3 signs. 1. You've redrawn or topped up your loan for anything private. 2. You don't actually know whether a renovation counted as a repair or as capital works. 3. You've never had a depreciation or capital works schedule done on the property. If any of those ring true, the next 3 moves are for you. 3 moves, let's do them. Move 1. Audit your interest deductions. Log into MyGov, open ATO online services, and download your last 5 years of notices of assessment and rental schedules. That shows you exactly what interest you claimed. Then pull your bank loan statements for the same period and flag every redraw and top up. This is general information, not personal advice. 3 steps. Download 5 years of notices and rental schedules from ATO online. Pull your loan statements and highlight every redraw and top up. Then classify each as investment or private and apportion the interest. What good looks like. The interest you claim equals your investment balance divided by total loan backed by evidence. Move 2. Reclassify repairs versus capital works. List every job over $1,000 done since you bought. Kitchens, bathrooms, roofing, flooring, structural changes. Use ATO guidance or a quantity surveyor report to split genuine repairs from capital improvements. Then set up a 2.5% capital works schedule for the structural ones using the ATO's depreciation tool. 3 steps. List all works over $1,000 since purchase. Classify each as a repair or a capital improvement. Then build a 2.5% Division 43 schedule and amend prior years if you need to. What good looks like? Only genuine repairs claimed in full, and every eligible structural improvement sitting on a 2.5% schedule. Move 3. Check genuinely available for rent. Review how often the property was used privately, by family, or at mates' rates. Keep a use diary and only claim the portion of expenses that relate to periods it was genuinely available at market rates, ATO 2024. You'll find your rental schedule under ATO Online Income Tax. 3 steps. Count the weeks used privately. By family or below market rent. Calculate your income producing percentage for the year. Then apportion interest, rates, insurance and cleaning to that share. What good looks like? Expenses claimed match genuine availability backed by a use diary. Why does this matter right now? Because the rules already moved. From the 1st of July 2017, individuals can no longer claim travel to inspect or maintain residential rentals, ATO 2024. Also from 2017, depreciation on second-hand plant and equipment in residential rentals was removed. And in 2023, the ATO named rentals a top focus, reporting that roughly 90% of reviewed returns had errors, ATO 2023. They now data match your loans, your agents, and your bond records. Once you've acted, verify it. You should see your claimed interest match your investment loan portion. Confirm your capital works are sitting on a 2.5% schedule, not expensed all at once. And if you found overclaims, lodge a voluntary disclosure. Coming forward usually reduces penalties. Everything here is built on ATO guidance and registered tax practitioner sources, all linked below so you can check it yourself. Today you learned why 90% of rental returns have errors and the 3 moves to fix interest, repairs and private use. Next week, negative gearing, and how the rules quietly cap the refund you think you're getting. If this saved you from a nasty ATO surprise, subscribe. We read the fine print so you don't have to.